St. Louis. This is what retirement means to you with financial advisor Jerry Means. He's the founder of the Means Financial Group. I'm Spike Spengel. Jerry, how are you doing?
I'm doing fantastic, Spike. How are you doing today?
I'm good. I'm curious what we've got to cover this week.
Well, I thought today we would talk about people retiring later versus earlier.
Okay. I don't know. So we're thinking about having to work longer, or is it not necessarily a bad thing to work a little bit longer?
I don't think it's necessarily a bad thing. It's just a trend that I'm seeing. People are tending to stay in the workforce a little bit longer if they have the opportunity to do that. I think a lot of that has changed because people are living longer in retirement. You know, when Social Security was enacted back in the 1930s, you know, everyone got full benefits at age 65. Today, depending on when you were born, it can be age 66 or age 67 in so many months, right? But when they enacted that, people were only living to be 62, 67, you know what I mean? So the Social Security didn't have to pay out for that much longer. Also, the pension companies weren't squeezed as much because they weren't having to pay as long. But today, now that people are living longer, a lot of these pensions are going away. We've seen the troubles with Social Security. So I think a lot of people, just as a security blanket, are trying to stay in the workforce a little bit longer, save a little bit more. I also think today people work out more. They are more conscious about what they're putting in their body. You know, we've got different vitamins and supplements and things like that. We have things like silver sneakers programs, you know, that weren't around 20 years ago. So there's things that people are doing to stay healthy, and they realize they might live 20 or 30 years in retirement. So they're extending that workforce. I also think part of that is people have changed a lot into professional careers, things that aren't as hard on the body. You know, my dad, for example, worked for the same company for 33 years, and he worked in a factory. My dad would have continued to work, but his body gave out, right? He just couldn't do it anymore and started getting back problems and things like that. So he had to retire, not because he wanted to, but because his body forced him to.
Yeah,
you know?
Yeah. Totally understand that. To support you there from the Center of Retirement Research Institute, back in the 1990s, the average age of men at retirement was about 61, 62. Today, it's about 65 plus. For women, it was 60. Today, women retire around 63 to 64. In the labor force back in the 1990s, only about 11% of folks were over the age of 65. Today, it's well over 22%. So the numbers are there, but you're right. It's a different kind of workforce. We're using a lot more of our brains and our fingertips than we're putting our backs into work. But there was something you said you specifically wanted to address the entire St. Louis area. There's also a way today that some folks are being kind of set into their early retirement without their decision.
Yeah, I mean, we've talked about this before on radio, but I had a really interesting conversation. I was at one of my favorite lunch spots, and I was kind of bellied up to the bar because that was the only place that you could sit without having a reservation. And I was just having lunch, and there was two people next to me, you know, a couple chairs down, and they weren't together, they were separate. And the gal next to me was a younger gal, and she started talking to the bartender about being laid off from her employer, and you know, that she had time off to come in and have lunch and all these things. And it was funny because two doors down was an older gentleman, or two seats down was an older gentleman, and he worked for the same employer. And he said, "Hey, that's me too, you know." And I told him, I said, "Well, I'm seeing a lot of people with your company come in to see me because they're tired, you know, they're 62, 63, and they don't want to go through another one of these layoffs or another one of these strikes. And they're trying to retire early and then do something different." He said, "Well, that's me. I'm in that boat." And of course, he asked for my card and all of that. But it was funny to see the two outlooks of the two different age differences, what their outlook was on the strike. It was completely different. But on top of that, I went and did some research and seen there was like 3,200 employees for that company that were on strike. And they have layoffs scheduled for January. But then I seen, just before we came to do this, to do the TV show, another company in our area that's laying off something like 750 people in the next couple of months. So I'm seeing this trend where companies are doing a lot of downsizing right now. And so, you know, I want to be able to help people. I mean, I'm a financial advisor. I'm a St. Louis native. I've lived there my whole life. I want to help people that are in that situation. So if you're on strike, you've been laid off, or your company's downsizing, whatever's going on, give us a call. Come in and sit down. Get your free on-track report to see, if you're going to be okay. Let's sit down and talk about it. Let's talk about what your options are. If you're not sure, there's no cost, there's no obligation to come in and have a conversation with myself or a member of the team, and we can walk you through the process of different things, how we've helped other people in a similar situation.
Thank you for addressing this for the St. Louis area right now, because if you're feeling that reduction in force, you're uncertain about the stability of your job, or if it's already happened to you, you're likely feeling pretty low. And the last thing you want to do is reach out and say, oh, how's my financial situation? You're feeling bad about it already. But if you've got savings, it's ironic because I had to take an Uber recently. It was a very nice car, and I started asking them some questions. She said, well, I actually have a job. I'm doing this on the weekends. My husband was let go, but we just sent our third daughter off to college. We paid the tuition and everything. And I said, oh my God. She's like, no, we're okay. They had all saved for all three of the kids into 529 plans. So the money was there. It was just, there's a change in the dynamic for the family. This might give them then some time to go and look for another job. So maybe that's what the on-track retirement report might do for you, is say, it's okay to take a few months, regroup, and find out where you want to step next.
Yeah, I care about my community. So, that's why we're making the offer. Give us a call, 844-878-1293. Come in for your on-track retirement report. Whether you're already retired and you want to stay retired, or if you're nearing retirement, it's a good time to call. Come in, sit down with us. Again, there's no cost, there's no obligation, and there's no pressure. We just want to have a conversation with you. We'll do things like look at what your current tax status is. Is there anything that we can do to help you save some money, put more in your pocket versus the government's? We also can look at your income plan. Do you have a guaranteed written income plan to make sure that you don't outlive your money in retirement? We can sit down and help you do that. We can make sure you're diversified, not just in different stocks and bonds and mutual funds and different retirement tools, but let's look at your tax buckets. How much do you have in pre-tax? How much is in Roth? How much is in after-tax accounts? We can sit down, help you diversify. All of these things we will do for you, no cost, no obligation. Just give us a call.
That number to call right now, we have folks standing by, is 844-878-1293. More of what retirement means to you with financial advisor Jerry Means right after this.
We're a pretty small boutique firm. When you come into our office, it really does have a family feel to it. My wife works in the office. My son works in the office as well. We also have our dog Maui. He's kind of the mascot. When you do come in, you meet our receptionist, Jen, and we call her the Director of First Impressions because she's great with people. We have a small building that I own. It's very easy to pull up and see us and walk in and get greeted right away. Something that I hear from a lot of people is they just feel comfortable. They feel like they're sitting down and sitting with a friend already. We just sit down with them and educate them and tell them about our services and what we do and how we do it and try to find out if we're a good fit. A lot of my staff is family. So it is a family business, and most people that come in, that's the most important thing to them is their family. So it's good for them to see that in our environment.
Thank you for joining us again. This is What Retirement Means to You with financial advisor Jerry Means of the Means Financial Group right here in the greater St. Louis area. Jerry, hot off the press, somewhat as expected. There was an announcement. What happened recently financially?
Well, the Fed cut interest rates a quarter point, and we predict that they're going to do 3 or 4 more rate cuts. So it's a good time to talk about refinancing your retirement.
Okay. Why if something is coming down, why would we want to take a look at tools that are based on interest rates? To me, it doesn't mean I'm going to get a really good income payout if interest rates are lower.
Well, in the past, we were looking at shorter term rates. As rates were going up, people were putting money into short-term money market accounts, CDs, things like that, hoping to get a decent rate of return for a short period of time. As rates go down, when those renew, they're going to get a lower benefit. So it might be a good time to look at locking things in for a longer period of time and taking advantage of today's rates before things go down. I mean, we know when interest rates go down to refinance our mortgage and things like that. When interest rates go up, it's a good time to refinance your retirement. But now that they've kind of hit a peak and they're starting to retract, there's still time to lock in some of these really quality rates. And this is a call us now kind of thing, not call us later. You want to act as soon as possible to make sure you take advantage of the rates that we have today.
Absolutely. As we're doing this broadcast right now, we want you to think about it. Do you have any interest rate-based tools, specifically annuities? We want to help you with that review. We'll do a second opinion review for you at absolutely no cost. There's no obligation. Jerry himself, a fiduciary, has to tell you if that's a good tool for you to use, if the costs seem to be in line. But if there could be better interest rates that are available, you'll let them know as well.
Yeah.
Now, maybe you also want to speak to the independence of who you are, because if you go to one specific carrier or group, they're probably going to talk about the tools that they have.
That is correct. So there's a lot of advisors out there that are something called a captive agent, where they can only sell a handful of companies. I, as an independent, I own my building, I employ my staff, it's my firm. I'm not beholden to anyone else, so I can use all of these different insurance companies at my disposal. I actually have this software program called Annuities Genius, which is a clever name, and I can sit down with people, and I do this in my office or on a Zoom call. I pull it right up on the screen and say, okay, Ben, you're 62 years old. You've got $200,000 in this CD or this old annuity or this bond, whatever it is. Let's see if we can find you a better interest rate. So I put things in like, we want to be able to have 10% free withdrawal liquidity features. We want to have the company be at least B++ or better rated. That's just my preference. And I can put in all of these different parameters, and all of a sudden it will populate the best rate to the lowest rate in the industry, not just one insurance company, but all of the insurance companies. So I can shop with the client right in front of them and really show them. And clients love it. They're like, well, what does the 3-year look like, Jerry? What does the 5-year look like? What does the 7-year look like? What does the 10-year look like? So how much, if I put this much in, how much interest will I earn? I can actually show them how much interest they will earn compounded over a certain period of time. It's a really fun tool to use with clients. It's business, right? And I'm there to help them, but we actually have a lot of fun doing it with people.
What is the better use of a tool like that on annuity? And we've talked before about people's emotions about annuities. Maybe I'd like to have an idea of what are some questions that our viewers should ask when somebody's talking to them about a tool like that. Independence is a big one, but what kind of features are you looking for mostly out of an annuity, or at general times for all of them? Do you want more growth? Are you looking for income? Are you looking for long-term care as a rider? What kind of preferences do you have?
So I like to break it down to 3 types of annuities. The first annuity is called a fixed annuity, often referred to in the industry as a MYGA. It's an acronym for multi-year guaranteed annuity. Works like a CD, but it's with an insurance company. It's multi-year guaranteed. So you can buy a 3-year, 5-year, 7-year, whatever that term is, and you know what that interest rate is. On the other end of the spectrum is a variable annuity, which the money's actually in the market, and it goes up and down. It's in mutual funds, and you're limited on how many different mutual funds you have to choose from. However, if the account goes down and you lose money and you die, your beneficiary gets at least the amount that you put in. So it has a life insurance feature there. However, those things can be very expensive. I've seen them range anywhere from 1% to 4% in fees, usually around that 3 or 4% range on the ones that I've seen. I personally don't like that tool. And I think that's the one that a lot of people get upset with, because if you lose money in the market in the variable annuity and you find out you're paying a 4% fee, you might not like annuities either. So I tend to stay away from that vehicle. But in the middle, there's one called a hybrid. It's a fixed indexed annuity. And this allows you to not lose any of your principal. It's protected growth, so you get some of the upside of the market with none of the downside risk, but up to a cap. So for example, the market goes up 15%, you might be capped at 9%, but you get that 9% added to your account, it becomes principal. You never can lose your original investment or interest that you earned. So it's kind of a way to play the market without having the risk. You get some of that upside, but you're not just getting that 4 or 5% fixed rate, you've got a chance to earn more over time. So it's a really good vehicle to use, but you wanna know what type of annuity that you're looking for. Are you doing it for income? Or are you doing it for protected growth? Or is it just a short-term vehicle that you're maybe trying to outpace CDs? So again, sitting down, having a conversation and understanding what that tool is gonna be used for determines on where we're gonna direct people to go. On top of that, you wanna know not only what type of annuity, but what are the fees in the annuity? Is it a variable? Is it a fixed? What are the fees? You wanna know what the surrender charges is. So One of the things about annuities, the reason the insurance companies give a better rate is because than the banks, for example, is it costs more to get out of them early. So you need to understand what the surrender charges are. There's things like, what are the riders available? And do you need a rider? Some people don't need income off of their investments. So they may not need an income rider. I'll have people come into my office and say, Jerry, I bought this annuity, and I'll start looking through it and I'll see that it has an income rider and they're paying a fee for it. And I'll ask, when are you wanting to trigger this income? And they're like, well, I really don't need income from it. I'm like, well, you're paying 1.1% for this rider fee. If that's a $500,000 account, that's a good chunk of change every year. You're paying for a benefit you don't need. So we can rescue them out of that annuity and maybe put them into something different, get them a higher rate, but also reduce their fees. So there's a lot of different things like that we can do for people.
And I know as a fiduciary, we have to be careful with this word as well, but can you talk to me about bonuses? I've heard about bonuses on certain types of annuities. Why would an insurance company offer to give you another 10 or 15 or 20% just for using their tool?
So a lot of times that is just to offset surrender charges to get out of another tool, right? If you don't have surrender charges, then it's just cream on top, right? But it's an enticer, it's a way to get people to come in and look. I mean, there's companies right now paying 17% bonuses, 20% bonuses. Now, again, I have to put in there from the fiduciary standpoint, if you surrender the contract early, they'll claw back that bonus. It's on a vesting schedule, but they do give it to you up front, so you're earning interest on that money right away. So, for example, if it's a 20% signing bonus, you put $100,000 in. We deliver a contract for $120,000, and whatever interest it earns over the next year goes in that whole $120,000. But if that's a 10-year contract and they surrender it in year 6 for some reason, they're going to claw back some of that, and they're going to have surrender charges. But that's why we don't put money in there that you need right away. That's why it's important to diversify, have a protected growth bucket, an income bucket, then have your liquidity bucket that's in the market. So you shouldn't put money into an annuity that you want to turn around and pull money out anyway before the surrender charge, unless it's for income and the plan's designed to do that, because there's no charges for the income rider to be triggered.
So much that goes into it. I hope some of these thoughts and these questions for you have helped. But right now, we want to let you know we'll do a second opinion review on any annuity tool you have, any life insurance tool you have, or if you've been considering one either for income or growth. Call the phone number. We'll give you an absolutely free second opinion. 844-878-1293 is the phone number. You'll be able to speak with Jerry himself of the Means Financial Group. In fact, you've put together another tutorial, just a little bit more right here on annuities. Don't go anywhere.
There's no shortage of opinions about annuities. Some people love them, others hate them. But here's what matters. The right annuity in the right situation can solve very specific retirement challenges. Whether it's guaranteed income, market protection, or legacy planning, different annuities are built to serve different purposes. The problem is, too many people own annuities that no longer match their goals, or worse, never did. Some have high fees, others come with outdated features, and too often, people buy them without understanding what they're getting. If you've been holding on to an annuity for years, or if you're not sure exactly what you have or how it works, now is the time to take a second look. Our complimentary annuity review can help you understand what you own, what it's doing for you, and whether something better is available in today's market. Refinance your annuity today and make sure it's working for you, not against you.
Welcome back to What Retirement Means to You with financial advisor Jerry Means of the Means Financial Group. He's right here in the greater St. Louis area. We're talking about some of the tools we want for retirement. The opening of the show, we talked about, are we going to be fashionably late to our own retirement? It seems like we are working a little bit longer and later. Our retirement years are about 3 or 4 years later on average for men and women than they used to be, in part because we are living longer, living healthier, living great lifestyles. But we got to make sure we've got tools that we don't outlive our income. Is this why you're talking about the annuity tool today?
Yeah, I mean, people are living longer, and that's the great thing about these tools is you can't outlive the income. If you have a properly structured income rider on top of these annuities and you start taking income, the way it works, Spike, basically is you put money in there. Let's say I always use 100,000 because it's easy numbers, right? You put 100,000 in, every insurance company does it a little bit different. There's all these little nuances, but it's the same basic principle. And we help people go through the weeds and find out what's best for their situation, because we have tools to help us narrow that down. But basically, you put 100,000 in, yeah, you get a bonus. Yeah, it can grow. Like if we do the fixed index annuity, based off market returns without market risk. But they grow it at a certain percentage every year, regardless of what the market does. So some of them use, for example, 7%. So you put 100,000 in, every year that income bucket grows by 7%, regardless of what the market does. The longer you wait, the more income is going to pay out, because there's more time for that bucket to roll out. Again, that's why we talked earlier in a different segment about the in-service rollovers, because we can get that clock started sooner.
Get that clock started.
And get that 7% rolling up. Well, when people decide to take income, they look at that income bucket. They have a chart, an actuary chart that looks at their age. For the listeners, you don't have to keep track of all of this. I'm just getting in the weeds a little bit. We do all this for you, and we have illustrations that we can draw out and show you every single year how much your income would be. But they take that percentage times the income bucket, and it tells you what their lifetime income will be. And they can do joint income. So it's like a pension. You get that as long as you or your spouse are alive if you do the joint income, or you can do a single life income. You get a bigger payout, but then the beneficiary just gets what's left in the bucket if you do that. Most clients that I sit down with, especially if they're close in age, will do the joint payout, meaning one spouse passes, the income continues. And they get that. Now, if they don't use all of the income, the beneficiaries still get what's left in the bucket. Unlike a pension, where if you don't use it all, it goes back to the pension company.
Or Social Security.
Or Social Security,
when you pass away, it's not like somebody starts to get paid for the rest of the life that you didn't get paid back on your Social Security. That's just gone.
Yeah. Now, some of the companies, not all of them, have a kicker as well. They don't call them long-term care riders, but they call them, they have different names for them, accelerated benefit, things like that. But basically, if you need long-term care, if you can't do 2 of 6 activities of daily living, eating, bathing, transferring out of bed, there's 2 of 6 of those things. A doctor just has to say you can't do that. We file a claim, they will double the income. So, and there's no qualification to get into one of these. So if you apply for a traditional long-term care insurance, right, you have to go through the health procedures and the medical records and all of that. To buy an annuity with an income rider that has an income doubler for long-term care, there's no qualification. The only qualification is you can't be in a nursing home when you purchase the annuity. Okay. That's the only question, is, are you currently in a nursing home? If you answer no to that, you can get the benefit. Now, there is a fee for that, and different companies charge different fees. Usually it's around 1%, give or take. But what a great benefit. It's a lot cheaper than long-term care. Now, it might not pay for the whole stay, but it definitely can help go with other assets and help soften the blow for sure.
So it'll double the income, or maybe I've even heard of triplers, or those, if those exist out there, and usually for a period of time, right?
Correct.
3 years or 5 years or something like that.
Yeah, so there's 2 different types. There's a regular income rider that has a doubler if they need long-term care. Then there's annuities that you put, let's say you put $100,000 into it, you're earning a fixed rate, let's say 5%, which is a great rate, right, to begin with. But if you need long-term care, they just double it, or triple it, and it's already $300,000 worth of money that you can use for long-term care. So there's 2 different ways that you can do that. And I usually walk people through different illustrations just so show them the pros and cons of each one of those.
Right. All of these different tools to remind folks, if you're just joining us right now, that you are an independent financial advisor talking about this. You've got you said a great tool on being able to compare all of them out there. But with the announcement recently of interest rates that have been coming down for this year, is it important to act sooner than later? Because I don't think the interest rates inside these tool offerings are going to remain as high as they have been.
No, that's correct. We've been helping people refinance their annuities for the last couple of years, since 2022 when rates went up. It was a great time, and a lot of people are probably sitting at home going, "Well, I already purchased an annuity. I don't know that I can get out of it." Those bonuses can help you get out of it and maybe get into one that's going to pay a higher rate. Also, we can lock in some of today's rates. The funny thing about the insurance companies is when interest rates go up, they don't go back and give you someone that bought it previously that higher rate. That's only for the new customers, right? It's kind of like the cell phone companies. They will give a new phone.
Cell phones, shell switch.
We're going to give you a new phone for a new customer.
I've been with them for 14 years. Why don't I get a deal?
So the insurance companies don't go back and raise the rates on previous annuities that were already in place. Same thing. If you get in today's rates and the rates go down, you're locked in though to those rates today. So those rates It depends on what type of annuity you have, can either stay the same. They might switch a little bit, but it's a great time to take advantage and lock in, at least for the next year, a better interest rate.
Is it a fair analogy to say, I'm sure a lot of folks out there have turned in a car that they leased for a 5-year period, somewhere in a 2 or 3 year period, but they were able to trade it in maybe at the same kind of dealership or something like that for somewhere around the same costs? I mean, people have traded in contracts.
It's a great analogy. I mean, actually, I had my own clients that I moved to different annuities because the rates went up. And I either got them more income or a higher interest rate or a lower fee. So it's always a good time to sit down and do a review of those products, whether you bought it a year ago, 5 years ago, or 10 years ago. It never hurts to get a review and understand what else is out there.
What you've been so great at lately is that you'll talk about specific tools, or whether it's taxes or whether it's estate planning, which we're going to talk more about this month, is that you also have a plan. It's not just talking about one set of tools or strategies. Why don't you talk about the on-track review and the complete report that folks get when they come in?
Yeah, so if you give us a call, the number on the screen, and you come into our office, you're going to sit down with myself or a member of my team. There's no cost, no obligation, and more importantly, there's no pressure. We understand that this is going to be a big decision for you if you want to make any changes, and we don't rush anyone. But don't wait back. Come in, sit down, talk to someone right now before interest rates change anymore. While the market's at all-time highs, we can talk about that as well. You know, if you're afraid of the market retracting, those are things that we can discuss. But really, it's just a conversation. And then if you would like, we will do our on-track retirement report, where we're going to do a written income plan for you. We want to make sure that you don't run out of money in retirement. We can look at your tax situation. Is there anything that we can do to help you on your next tax return or tax returns in the future? We're going to make sure you're diversified into different tax buckets, not have all of your money into pre-tax. What can we do to maybe get some into a tax-free bucket? We can sit down and help you with that. We want to look at the fees in your portfolio. Are you paying any excessive fees for things that you may not even need? Come in, sit down with us. We're happy to do that. There's no cost, no obligation. Give us a call, 844-878-1293.
Jerry Means, financial advisor, thank you so much for taking this through all of the steps of this today. You might think that you're going to be working longer than you want to, but you're not being fashionably late to your own retirement. You are planning for a future with an income that you can't outlive. Call that phone number so we can get you started on your own on-track retirement report.